Right now, something unusual is moving through the global financial system, and most people are completely unaware of it. Markets across commodities, currencies, and bonds are quietly reacting to a potential policy shift tied to Donald Trump's economic strategy, and the implications could be massive. Analysts are beginning to warn that the ripple effects of this policy could trigger a market movement worth more than $200 billion across multiple sectors. What makes this moment different is not just politics, but the way capital is repositioning across global markets. Institutional investors are closely monitoring precious metals, especially silver, because the structure of that market is extremely sensitive to large capital inflows. When policy changes alter trade rules, manufacturing incentives, and resource-independent strategies, the demand for strategic metals can shift dramatically in a short period of time. Silver is particularly important because it sits at the intersection of finance and industry. It is both a store of value and a critical industrial input used in solar panels, electronics, medical devices, and emerging technologies. When macroeconomic policy begins pushing industrial demand higher, while investors simultaneously search for inflation protection, the result can be explosive price movements. The reason analysts are paying attention right now is because early signals are already appearing in futures markets, inventory data, and institutional positioning. These signals suggest that something larger could be forming beneath the surface of the financial system. Markets rarely move in isolation, and when geopolitical policy intersects with commodity supply chains, the effects can cascade across the entire global economy. What we may be witnessing right now is the beginning of a structural shift that could redefine how investors think about precious metals and industrial commodities for years to come. At first glance, a policy shift connected to trade or manufacturing might appear to affect only specific industries or international relationships, but the reality is far broader. The global economy is built on interconnected supply chains, and when major economic powers change the rules governing trade, investment, or domestic production, the effects ripple through nearly every sector. This is why financial analysts are watching the situation so closely. If a policy accelerates domestic manufacturing and increases tariffs on foreign goods, it can reshape the flow of raw materials, particularly strategic metals like silver, copper, and rare earth elements. These materials are essential for industries ranging from renewable energy to semiconductor production. When demand for these materials increases rapidly, while supply remains constrained, prices can rise sharply. That price movement does not stay confined to commodity markets. It affects manufacturing costs, energy prices, technology production, and even consumer goods. Businesses that rely heavily on industrial metals suddenly face higher operating costs, which can reduce profit margins or force companies to raise prices. At the same time, investors begin reallocating capital toward sectors that benefit from rising commodity prices, creating volatility across financial markets. Pension funds, hedge funds, and large institutional investors constantly monitor these shifts because they can signal the beginning of larger economic trends. If silver and other strategic metals begin moving aggressively due to policy-driven demand, the capital flowing into these markets could easily reach hundreds of billions of dollars globally. For everyday people, this process eventually shows up in the real economy through higher prices, changes in investment performance, and shifts in employment across manufacturing sectors. That is why a seemingly technical market development can quickly become a major economic story affecting businesses, governments, and households worldwide. The moment that sparked renewed attention from financial markets came when discussions around Trump's proposed economic policies began circulating among investors and policy analysts. These proposals emphasize aggressive domestic manufacturing incentives, stronger trade tariffs, and strategic resource independence. While such proposals are often framed in political terms, markets immediately began calculating their economic implications. Within hours of these discussions gaining traction, activity in commodities markets started to increase. Silver futures saw noticeable buying pressure, and trading volumes rose significantly as institutional investors adjusted their positions. Analysts noted that silver prices moved several percentage points within a single trading session, which is substantial for a market that typically moves gradually. At the same time, investors began examining supply chain dynamics more closely. If new tariffs and manufacturing incentives encourage companies to produce more goods domestically, the demand for industrial inputs like silver could increase sharply. Solar energy technology, electric vehicles, and advanced electronics all require significant amounts of silver. A sudden surge in manufacturing demand, combined with tight global supply, could create a powerful market imbalance. Financial institutions also began reassessing inflation expectations. Policies that promote large-scale industrial investment can stimulate economic activity, but may also increase cost pressures across supply chains. That combination often drives investors toward precious metals as a hedge against currency devaluation or inflation. This is why both gold and silver began attracting increased attention from institutional traders. While the broader public may view this as just another political headline, professional investors understand that policy signals often precede major capital shifts. The trigger moment was not simply a policy discussion. It was the realization among market participants that a structural shift in demand for strategic commodities could be approaching. To understand why analysts are talking about a potential $200 billion market shift, it is necessary to examine how the silver market actually works. Unlike many other commodities, silver operates within a unique structure where financial derivatives often dominate price discovery. Futures contracts traded on exchanges represent enormous quantities of paper silver compared to the amount of physical metal available in global inventories. This system works smoothly under normal conditions because most contracts are settled financially rather than through physical delivery. However, when demand for physical silver begins to rise, while speculative trading remains heavily leveraged, the balance between paper supply and physical availability can become unstable. If industrial demand accelerates due to new manufacturing policies, companies may begin purchasing more physical silver to secure supply for production. At the same time, investors seeking protection against inflation or currency instability may also accumulate bullion. This dual demand from industry and finance can strain inventories stored in exchange warehouses. When inventories decline while futures traders remain heavily positioned, even small changes in market sentiment can produce large price movements. Another important factor is the relatively small size of the silver market compared to other financial markets. Global silver trading volume is substantial, but the total investable market is tiny compared to equities, bonds, or currencies. This means that when institutional capital begins reallocating towards silver, prices can move rapidly because the market simply cannot absorb large inflows without significant adjustments. The core mechanism driving concern among analysts is therefore not just policy change, but the structural fragility of a market where paper claims vastly exceed available physical supply. When commodity markets experience sudden price shocks, the consequences extend far beyond trading floors and investment portfolios. Businesses that rely heavily on industrial metals are often the first to feel the impact. Manufacturers operating with tight margins can face immediate cost pressures when the price of key materials rises quickly. Industries such as solar panel production, electronics manufacturing, and automotive technology depend heavily on silver for electrical conductivity and high-performance components. If silver prices surge significantly, companies may be forced to either absorb higher costs or pass those increases on to consumers. Small and medium-sized manufacturers are particularly vulnerable because they often lack the financial flexibility or long-term supply contracts that larger corporations use to manage commodity price volatility. Rising input costs can reduce profitability, delay expansion plans, or even force businesses to cut jobs. For workers, these disruptions can translate into layoffs, reduced wages, or uncertainty about the future of entire industries. On the consumer side, price shocks in strategic materials eventually filter into everyday products. Electronics, renewable energy systems, and advanced medical equipment all rely on metals like silver. As production costs increase, the final price of these goods may also rise, contributing to broader inflationary pressure across the economy. Financial markets amplify these challenges by responding quickly to perceived risk. Investors may shift capital away from companies exposed to rising commodity costs and into sectors expected to benefit from the price surge. That process can trigger sharp stock market volatility, affecting retirement accounts, investment funds, and corporate valuations. What begins as a shift in commodity demand can therefore cascade through the entire economic system, creating ripple effects that impact workers, businesses, and consumers alike. One factor that could intensify this situation is the broader global inflation environment. Even though inflation rates have moderated compared to the peak levels seen in recent years, underlying structural pressures remain present across many economies. Energy costs, transportation expenses, and labor shortages continue to influence production costs worldwide. When governments introduce policies aimed at expanding domestic manufacturing, those pressures can become even more pronounced. Large-scale industrial investment requires raw materials, skilled labor, and energy infrastructure, all of which place additional strain on supply chains. If the demand for industrial metals increases rapidly, at the same time global supply remains constrained, commodity prices can rise significantly. For silver, this dynamic is particularly important because the metal serves both industrial and monetary roles. Investors often treat silver as a hedge against inflation, meaning that rising inflation expectations can drive financial demand at the same time industrial demand is increasing. When these two forces occur simultaneously, the resulting market pressure can be much stronger than analysts initially expect. Central banks also play a role in shaping these dynamics. If inflation remains persistent, monetary authorities may hesitate to cut interest rates aggressively. Higher interest rates typically strengthen currencies and suppress commodity prices, but the relationship is not always straightforward. If investors believe inflation will remain elevated regardless of central bank actions, they may still seek protection in hard assets, such as precious metals. This complex interaction between policy, inflation, and commodity demand is why financial analysts are closely monitoring current developments. Inflation alone can create volatility in metals markets, but when combined with major policy shifts and structural supply constraints, the effects can compound rapidly. Another factor amplifying uncertainty in the metals market is the growing fragmentation of global trade networks. Over the past decade, the international economic system has gradually shifted away from the highly integrated globalization model that dominated previous decades. Countries are increasingly prioritizing national security, domestic production, and strategic resource independence. This trend has accelerated as geopolitical tensions reshape alliances and trade partnerships. When major economies implement tariffs, export controls, or domestic manufacturing incentives, global supply chains must adjust. These adjustments often reduce efficiency and increase costs because companies can no longer rely on the most cost-effective international suppliers. Instead, production may shift to regions where resources are more secure, but also more expensive to extract or process. For metals markets, this shift can significantly affect supply availability. Many strategic minerals and metals are concentrated in specific regions of the world, and disruptions in trade relationships can limit access to these resources. If new policies encourage domestic industries to secure local supply chains, demand for certain metals could increase sharply within specific regions. At the same time, geopolitical tensions may discourage international cooperation in resource development, slowing the expansion of global supply. The result is a market environment where both demand and supply are influenced by political decisions rather than purely economic efficiency. Investors understand that when commodities become strategically important to national economies, price volatility tends to increase. The silver market is particularly sensitive to these dynamics because it sits at the intersection of technology, energy transition, and financial hedging. As geopolitical pressures reshape global trade flows, metals markets could experience structural changes that extend far beyond short-term price fluctuations. The potential impact of these developments extends beyond commodity markets and into the broader national economic landscape. Governments increasingly view strategic resources as essential components of economic security. Metals like silver, copper, and rare earth elements play critical roles in modern technology, renewable energy systems, defense equipment, and advanced manufacturing. When policies encourage domestic production of these technologies, the demand for underlying materials increases dramatically. This creates both opportunities and challenges for national economies. On one hand, expanding domestic manufacturing can stimulate economic growth, create jobs, and reduce dependence on foreign suppliers. On the other hand, rapidly increasing demand for strategic materials can strain domestic supply chains and push prices higher. Policymakers must balance these competing forces carefully. If commodity prices rise too quickly, industries may struggle to maintain competitiveness in global markets. At the same time, securing access to essential resources remains a priority for long-term economic resilience. Financial markets respond to these dynamics by adjusting capital allocation across sectors. Investors may increase exposure to mining companies, commodity producers, and infrastructure projects linked to resource extraction. At the same time, industries heavily dependent on raw materials may face valuation pressure due to rising input costs. The national impact of these shifts can therefore extend into employment trends, investment flows, and technological development. For countries seeking to lead the next generation of industrial innovation, securing reliable access to strategic resources is becoming increasingly important. This is why policy discussions about manufacturing, trade, and resource independence are attracting intense scrutiny from financial analysts and institutional investors around the world. Financial markets rarely change direction overnight, but major structural shifts often begin quietly before becoming visible to the broader public. The current situation surrounding policy discussions, commodity demand, and global supply chains may represent one of those early turning points. Investors are starting to recognize that the intersection of geopolitics, industrial policy, and resource scarcity could reshape commodity markets over the coming decade. Silver sits at the center of this transformation because it functions as both an industrial metal and a financial asset. When policy encourages rapid expansion in technologies such as solar energy, electronics, and advanced manufacturing, industrial demand for silver increases. At the same time, uncertainty about inflation, currency stability, and global trade encourages investors to accumulate precious metals as a form of protection. These two forces together can create powerful market momentum. Analysts caution that predicting the exact timing of market shifts is extremely difficult, but the underlying structural trends are becoming clearer. Global supply chains are being redesigned, strategic resources are gaining political importance, and institutional investors are watching commodity markets more closely than they have in years. If capital begins flowing into metals markets at a significant scale, the resulting price movements could be substantial due to the relatively small size of these markets compared to global financial assets. The key message for investors is not panic, but awareness. Understanding how policy decisions influence commodity supply chains and financial markets can provide valuable insight into future economic trends. As the global economy evolves, the relationship between geopolitics, industrial demand, and precious metals may become one of the defining financial stories of the coming decade.